Welcome back. You're watching us on Smart Money. This is the year-end special. We're speaking to Sandeep Tandon, the founder and CIO of Quant Mutual Fund, and someone who has given great returns to shareholders in not a 1, 2, but even a 3-year time frame. Some of his funds have given you 30, 35, even 40% returns in the last 3 years. But one thing that Sandeep is well known for, and perhaps even sometimes accused for, is churning his portfolio a lot. There's a good amount of churn in your portfolio, right? But you believe that's a good thing. Explain.
So, Sonia, what happens? Churn, like in India, has been taught like, if you don't have a strategy and hence you churn, okay? For us, churn is all about rebalancing, okay? It's a mathematical term. We believe in dynamic style of money management. If data points are changing globally and we manage money in dynamic way, and hence we rebalance our portfolio also dynamically, okay? So, dynamic rebalancing, can it lead to a churn? Answer is yes. But we have been taught churn is bad. Actually, churn is good because we call churn is a great risk mitigation tool, okay? So when we talk about a risk on environment, my portfolio construction will be very different. If a risk off environment, my portfolio construction has to be different. That is the only way. Not only I'll protect my downside, and risk on environment will generate extra alpha. So in good times in risk on environment, our portfolio is skewed in such a manner that we generate extra alpha. In risk off period, our portfolio design in such a manner that it protects the capital, okay? So risk on risk of environment, it's a key reason for a churn, okay? We very nicely say churn is good.
Yeah, okay. The purpose of this show is for the retail investor to know some tools on how to manage their own portfolio. So for someone who's perhaps has a portfolio of 10, 15 stocks or even more, would you recommend they churn? And at what point do you decide, okay, this much profit is enough, now I need to exit the stock?
So yes, for us it's relatively easy because we as a house do a lot of analytics, okay? Maybe not necessary that tools or experience they have, okay? But what is very important for us is that in the market, something through the help of liquidity analytics and risk appetite we have learned over a period of time, entry are good, but exits are more important, okay? I have seen a lot of people get entry rights, from behavior perspective, but just observation, you will able to identify a trend and you will able to identify sector or stocks. But exits becomes very difficult because you get emotionally attached, okay? Because you think this stock has delivered so much return, this is good, everybody is talking about, research reports are so positive, whole world is constructively what happened in New Age company in September 2000. But there are data points. Let's say if you can't even analyze or connect the dots the way we connect because of our mathematical knowledge or the analytics tool which we use, okay? But by just simple observation is there, when you say too much hype is there, too much greed is there, everybody is talking about, the channels are talking. So we look at the narrative. If narrative is extremely positive, okay, that's the time you should prune down your exposure in a very simple terms, okay? Because markets are driven by narrative in short term. Reality is different, which you will see over a period of time. So when you see the hype is getting built around you, extraordinary news flow is there, best of the channels are flashing news, best of the analysts are talking about, best of money managers are talking about, that's a time you have to be a bit cautious. Very simple terms you have to take. Not a contrarian call, it's a behavior thesis. So purely for observing the behavior of money managers or media or the analysts, you have some answers.
You said it's emotional, right? The attachment to stocks. I think many people that I've spoken to don't feel as good about their gains as much as they feel bad about missing out on that extra 10 or 15%, right?
Correct.
How do you manage those expectations?
So I tell you, Sonia, this is very interesting. This is actually a mind game, okay? Like how you have your fear, greed, your every individual has certain levels of fear, greed, anxiety, stress, okay, which can be very different from mine, okay? But if similarly stock and sector also has something similar behavior characteristic, okay? If you certain extent you can quantify these data points through, let's say, with the help of perception analytics, which we have built over a period of time, then you can identify these inflection points in life, okay? And what is very important for investor has to understand, let's say nobody can ever get at the peak of the cycle, okay? When we also sell a stock, it's not necessary this is the top of the cycle, maybe it can go up 30, 40% also. What is very important for us to see if the stocks have or sector has hit the most admired zone, okay? That's the time I will prune down and shift to something else, which is a neglected zone or the most hated zone. The probability of making more money is high because I not only protecting my downside, I'm actually keeping my upside is open because I'm buying a certain stock which was a hated and neglected zone for a while. Now it has potential to move up. So it is actually leads to a sector rotation or stock rotation, which actually generate alpha out of it.
Okay, interesting. How do you pick a stock though? What are the red and the green flags that you look at before identifying a stock? Not a sector, I'm talking about a company.
Okay. So since we are a very large macro house, we come from a very macro perspective to micro. Okay. So first thesis is all about how to spot the sectoral trend. So sectoral trend we capture through money flow analytics, we capture through business cycle analytics. So we do a lot of cycle analyst work also. We try to capture that. We were early to identify the sector. Then we come to stock specific. Now stock specific thing also, we also do the same thing, like say VLRT framework get implemented at the sector level, macro level, it also get. So we try to look at what is the valuation analytics, okay? So we give 1/3 weightage out there. So when we look at valuation analytics, we have built something called perception analytics, okay? How your P multiple is there, okay? Something similarly, we have built a concept of perception analytics, okay? P, a lot of people look at 3 years forward, but we look at the perception analytics based on the historical data. Because the challenge in the valuation analytics, when you look 3 years, 5 years forward, because based on assumption, okay, if assumption goes wrong, you have positive surprise or negative surprise. But when we build our perception analytics based on historical data, the probability of such surprises is not there. But it gives you a huge data. If you have a lot of data points, it helps. So instead of looking at pure valuation, we create a perception analytics, largely a behavior tool. We also try to see what sort of liquidity is there. Okay. So typically liquidity is the highest at the peak of the cycle, or liquidity is highest at the bottom of the cycle. So if you can get into liquidity analytics to the help of, let's say, in terms of overweight, underweight point of view, you can talk about how whether certain stocks are part of the certain indices. Not many data points you can combine. Then you look at what is the prevailing sentiments. Let's say few months back, people have given up pharma, people have given up metals, people have given up. Nobody even talks about some of the sectors now. So those are the sentiment when you see they're extremely neglected zone. So it's a combination. So we give 1/3 weightage on the valuation analytics through perception analytics, 1/3 on liquidity analytics, 1/3 on risk appetite. That leads to a better timing analytics for me. So timing analytics function of all 3 data points. That overall gives you a better answer. If you just look at pure valuation, you don't get all answers.
Okay. So for someone who is watching you right now, a young investor who started to, his stock investing journey, what is your recommendation to him? How do you go and identify good companies or sectors? Because as you said, data analytics is something that large firms like you have. People sitting at home and investing don't have those kind of tools. How do they approach it?
So the first thing we always say, don't start 100% of your capital with your own strength. Okay. You should give 70-80% to people like us or professional who can manage money. Keep 10-20% for your learning. As you build up these expertise, you can increase your exposure. And you see if your 20% returns or 20% of portfolio has done better than the mutual fund averages where you've invested, then you should increase your exposure. If they have not, then it means you need more time to learn. So this is the process, like market in the time we'll talk about is you have to spend time in the market to understand what is happening. So it's over a period of time, you will learn, you will make your own share bit of mistake. When you start experimenting 100% of your capital with limited experience, then the probability of blunders are on higher side.
Okay, got it. There are various styles of investment, right, in the market. There's growth investment, value, deep discounting, etc. Which category do your schemes fall into? And more importantly, given that we are at record highs of the market, what is the best style of investment now for the next 1 to 2 years?
Okay. So as I explained, we are unconstrained fund house. We are style agnostic, market cap agnostic, sector agnostic, thesis agnostic. Okay, then how we define? Since we are a macro house, we look at multi-dimensional approach. So it's a combination of qualitative, quantitative, and behavior. All 3 aspects is blended to put together and then gives me a better outcome. Okay, so when we are looking at the portfolio construction also, or opportunity, we look at a blending opportunity, because the blending opportunity gives me, it's like, when multiple, let's say talking about when you run a complex multivariance model, multiple data points are skewed on one side, it gives you a better outcome. Okay, when you are not getting a very clear picture, we don't take aggressive call. When multiple data points skewed on one side and day by day it's only improving, or the picture is becoming much more clearer, when you connect the dots, that's a time we will take a relatively aggressive bet either on buying side or the selling side. Okay. So it's a combination of these 3 approach which we try to combine, and hence we call it we are unconstrained house.
Okay, before we wrap up, what's the best piece of investment advice that you have received in your, say, 2-3 decade long journey?
So the most important thing I will say that emotional aspect, as I say, we all get emotional association with certain sectors, certain stocks. Some people say this work has worked for me, this has worked for me, or this is the way the best of the people are talking about. Okay, so I think that emotional aspect, you have to cut. Okay, that's a very important. Second most important aspect is that don't just rely on limited tools, which we always say the blended approach works better. Okay. Otherwise, what happens, your skewness create huge biases for you. Sometimes it can work in your favor and people get carried away. Like a lot of money managers have been very successful in certain periods because that style has worked. Let's talk about growth at any price. We talked about between August 2012 till September 2000. That was a cycle. Everybody who followed that thesis has played out well. But we have to look at much larger. That's the reason I say one has to become slightly unconstrained. Don't get associated with any thesis in life.
Okay.
The moment you get associated is emotional attachment. You
don't
should not
attach yourself to anything.
Yes.
Okay, I guess that's the case with everything in life, right? Not just the markets. But Sandeep,
Correct.
thank you so much for joining us and not only talking about the financial aspect of the market, but the emotional and behavioral aspect, which I think is very, very important. With that, it is a wrap on the year-end special. You guys have a great Christmas weekend. We'll see you again next week.